so much for tuning into today's live stream. Today is May 15th, 2025. And to begin today's live stream, I do want to take a look at the economic calendar here for today. So it turns out that we had, let's see here, we had unemployment claims, fully fed manufacturing index, and most importantly, we did have PPI here today. So PPI here, it turned out that we actually shrunk about negative 5% or negative 0.5%. So negative 5 basis points and negative 4 basis points. Year over year, I don't think we have year over year, but core PPI, we contracted negative 4 basis points, and just regular PPI month over month, we contracted negative 5 basis points. And negative number just means that the producer price index, it has decreased. So let's see here. So the change in the price of finished goods and services sold, and when producer, so let's see, when producers charge more for goods and services, the higher costs are usually passed on to the consumer. Yeah, it seems like it actually declined. So I'm just gonna ask. I'm gonna put this into ChatGPT to see what. Bless you. Let me see what ChatGPT says. Interpretation. So PPI measures the wholesale inflation, excluding food and energy. Both came in much lower than expected. Negative growth suggests disinflationary pressures. This can imply lower cost pressures on producers and may lead to easing inflation downstream. This, I don't know with the tariffs. I don't believe that to be true. Or, well, I mean, at least for this previous month, right? It could mean that prices on goods are starting to decline. But this was previous data, right? Unemployment excuse me. Unemployment claims stayed the same at a whopping 229,000. But yeah, we don't nothing too crazy, but yeah, here Walmart plans to raise prices because of, so like I think in the upcoming months this will begin to rise again, and CPI will also, rise. Well, actually CPI did rise, but just at a lower rate than expected. And yeah, here like these numbers were, I mean, completely different from the forecasted, right? Yeah, bye, man. Retail sales, it just slowed down. It's still growing, but at a lower rate than the previous month. This month it actually is increasing. It increased by 1 basis point. Slowing consumer contract, yeah. But to go check technicals here for today. So this was yesterday's daily candle. And the daily candle here from yesterday suggested to me that we were most likely going to take out the daily high. So this for me was the draw of liquidity, this daily high here. However, whenever we open up during the Asian session, we actually began to slowly drift and we actually ended up taking out the previous day low during the London session. So for me now, I don't necessarily have a daily bias, right? I mean, I like the fact that we retraced back into this inefficiency here, right? So this inefficiency here on the daily time frame should be respected, to be honest, because let's take a look at the way that this weekly candle is closing. So that is the current weekly candle, and it's closing pretty much bullish, right? We didn't even like manipulate lower. As soon as we opened up on Sunday, we just went straight up. And so I believe we're going to close bullish here on this weekly candle. We only have 1 day left, which is Friday's trading. And I honestly don't believe that we're going to reverse and sell off on Friday. I mean, who knows? We might do that. It's just the probabilities of that happening is slim. But yeah, I really do like the idea that we should respect this inefficiency here on the daily time frame. So coming into today, I'm not necessarily going to force an idea. I'm not going to force, for us to take out previous day high, because I mean, we could, but like, I don't want to rely on the daily time frame for an objective, right? The daily low has already been taken. My best bet coming into today is to rely on the 4-hour time frame, the 6-hour, the 8-hour, or the 10-hour time frame for some sort of intraday bias, right? That for me would be the most logical approach. So what does that mean? That means coming into the morning session today, I'm actually going to rely on the 4-hour candle and the 8-hour candle. So depending on how these two candle closes here on the 4-hour and the 8-hour will tell me if, we're most likely going to take out the 4-hour high, will we take out the 4-hour low, or will we take out, the 8-hour high here, or will we take out the 8-hour low? So depending on how we close here on those two specific time frames, that will give me an intraday bias, right? Like I said, I'm not going to rely on the daily time frame, nor am I going to rely on the weekly time frame. Let's go check out what the 2-day candle closed like. So the 2-day candle here closed pretty bullish, right? This is the previous 2-day candle, and with the way that we closed here, this up closure, I can anticipate that we're most likely going to take out that 2-day high. Let's take a look at the 3-day time frame. So the 3-day time frame closes here in about 7 hours. So we're gonna close on this 3-day candle in 7 hours. Let's take a look at the 4-day time frame. 4-day time frame also is suggesting higher prices, a continuation. So I'm bullish here, right? Coming into this upcoming day, tomorrow, and the upcoming week. Like I said, I'm not really anticipating for this weekly candle to close bearish. It's not something that I'm anticipating. I'm anticipating an up close candle here on the weekly time frame, and I like the idea of us taking out the weekly high in the upcoming week, but that's for another video. But yeah, that's my technicals here for the morning at least. I did have a trade here yesterday that I do want to go over with you guys. Give me 1 second. I'm gonna get some water. The trade that I took yesterday, I have about 17 minutes to go over this. So let's start off with the higher time frame objective here. And I actually want to turn this into a video, so let me just... Alright, thank you guys so much for tuning into today's video. Today I'm going to be recapping the trade that I took on May 14th, 2025. And it was on a Wednesday, and my model was a 15-minute model. And let's dive right into it. So to begin today's, or to recap yesterday's trade here with you guys, I wanted to point out the higher time frame objective here. So let's take a look at this hourly candle. So this hourly candle here, with the way that we close here, my best assumption is that we're most likely going to take out this hourly low. And I'm pretty much bearish, right, for the next hour. Because if I want to see prices take out the hourly low, that means I am favoring prices to continue lower. So I'm bearish. I know that I'm going to be bearish for the next hour or so, right? So that means on the lower time frames relative to the hourly time frame, I have to find some sort of bearish model that aligns myself, that aligns me with the bearish hourly order flow. So what I mean by on a lower time frame relative to the hourly, I mean, you know, the 15-minute, the 30-minute. One of those two time frames will provide me with a model that aligns with the hourly bearish order flow. And one thing I did want to mention here too is that we did take out previous day high here coming into the morning session, or like London session. So it is good that I didn't rely on the daily objective, because the daily objective has already been taken. And you guys may not see this, but this high right here, right where my mouse is the 6-hour candle's high. And we actually took out that 6-hour candle's high, and then we created this bearish hourly candle. That means that I can't rely on the daily time frame because we took out the daily high, and we also took out the 6-hour high, meaning I can't rely on the 6-hour time frame. So if I know that I can't rely on those higher time frames, such as the daily, the 6-hour, the 4-hour, right? My best bet is to zoom into the hourly time frame to possibly find a even more zoomed in approach. It doesn't mean that I'm completely ignoring what the higher time frame is telling me, but I have to then be a little bit more nimble, because I understand that this is just a hourly bearish model, right? I'm not targeting I'm not targeting a weekly low or a monthly low. I understand the parameters and the objective of that specific trade here, which is the hourly low. I'm not targeting for, rock bottom. I'm targeting only what the time frame and what the objective is telling me, which is the hourly low. So to zoom in just a little bit, like I said, I'm gonna now find a model that aligns myself with the bearish hourly order flow. So going from the hourly time frame, I zoom into the 15-minute time frame. And then going into this 15-minute time frame, I noticed that, hey, this 30-minute candle here, and this is going to be a little bit confusing, but this is a indicator that I have on my chart. It allows me to see like different time frames on like one main time frame. So these are my main candles here. So all of these candles are 15-minute candles, but this indicator allows me to see what's happening on the 30-minute time frame and the hourly time frame. And whenever I zoomed into the 15-minute time frame, my indicator showed me that, hey, this 30-minute candle here has the same 30-minute low as the hourly low. So that means that my higher time frame objective which was on the hourly time frame, just got zoomed in, just got scoped into the 30-minute time frame. So now, the way that I interpret that is that we should complete the hourly objective within the next 30 minutes instead of the next hourly, right? So I have a specific time window that I am anticipating for this objective to be completed. So within the next 30 minutes, I want to see us take out the 30-minute low / hourly low. So now going into the 15-minute time frame, I noticed that, hey, this 15-minute candle here, its low is not the same low as the 30-minute low or the hourly low, but the way that we close there on this 15-minute candle is suggesting to me that, hey, we're most likely going to take out the 15-minute low. So like within the next 15 minutes, right, we should open, manipulate higher, preferably towards some sort of fair value gap, and have that fair value gap send us lower, attacking the 15-minute low and the 30-minute low. So that's my model, right? That 15-minute candle suggests lower prices. And what is my higher time frame telling me already? The higher time frame objective is telling me that, hey, we should continue lower towards the 30-minute low and the hourly low. So now that I have my higher time frame objective and my model, the only thing left for me to find out, or I guess have, is my entry pattern. Entry pattern is always going to be a fair value gap. With the way that you guys trade, you guys can use order blocks, breaker blocks, mitigation blocks, whatever blocks that you guys want to use. But my favored, entry pattern will always be a fair value gap. It's easy to see. There's a lot of fair value gaps, but with the way that I view prices, I know which fair value gap to use and which fair value gap should be respected in the direction of my bias, right? And so let's zoom in just a little bit more. So going from the 15-minute time frame, I should now go on to maybe the 1 hour, the 1 minute time frame, the 2 minute, 3, the 4, or the 5 minute time frame. Okay, and before we zoom in, I do want to mention that, so there is a dealing range here from this 15-minute swing high to this 15-minute swing low. And with the way that we closed here on this 30-minute time frame, we honestly should take out this 30-minute low, right? Which was the higher time frame objective to begin with. But we should take out this 30-minute swing low and expand lower towards the discount of the dealing range. So a dealing range, like I said, is created by a swing low and a swing high. And some components of a dealing range is that a dealing range is going to have a discount level and a premium level. When we're bearish, you can target the discount of the dealing range. And whenever we're bullish, you can target the premium of the dealing range. And this could be like thought back as just regular, like whenever you enter a supermarket, right? And you see discounted prices, you see a discounted item that's usually not discounted, right? You're most likely, as a buyer, you want to buy when prices are in discount. And whenever, let's think of that as in reverse. As a seller, you want to be selling when prices are high. So apply the same concept, but onto the markets here. So, like I said, because we're suggesting bearish, like a bearish bias, this confluence, this idea that we should retrace back into discount is very impactful, right? It's like another person pulling prices down. It gives you more of a reason, more of a confluence for lower prices. So with that in mind, let's go on to the 1 minute time frame to really show you the entry pattern that I use to take out the 15-minute low and for prices to continue to expand lower towards the 30-minute / hourly low. So there is a really small fair value gap here, right? As you guys may not be able to really see it clearly, but it's that grayish black line that goes through the chart right there. And this fair value gap should be respected. We should respect this fair value gap and then expand towards the 15-minute low and expand towards the 30-minute / hourly low. And so let's just zoom in here just a little bit more. So you can see prices here. We opened up here on that next 15-minute candle. We opened up, we trade into the fair value gap. We tap into it, and then we start to decline. We start to decline towards the 15-minute low and expand lower towards the 30-minute low. And this, like I said, was my bias, right? And that green box is the discount of the dealing range. One thing that I do want to mention is that the 1 minute fair value gap was created within my 15-minute model. So this 15-minute candle here is my model. And this 15-minute candle was created within 15 minutes. And the fair value gap here that I used to enter off of was created within that 15 minutes that created my model. So it's a valid entry pattern to use. And yeah, you guys can see here that I use some standard deviations to have, projected, just to have more targets in mind. So, there's that negative 0.5 level, -1, -1.5, -2 to -2.5. Usually prices tends to have a retracement during that little area there. But yeah, so that's the trade. Very simple approach, right? The 3 components that you do want to take away from this trade is that I had a higher time frame objective. I had a higher time frame reason for lower prices. The only thing that I needed to do was find a model that aligns myself, that is able to align myself with the higher time frame draw of liquidity and an entry pattern for me to actually enter into the trade and take the trade, right? So that's the trade from yesterday. Hopefully that was able to, hopefully that I'm able to show you guys how I view prices and how I actually take a trade. But yeah, thank you guys so much for watching, and until next time, be safe. All right, hopefully, now back to the stream. Hopefully that was insightful. I was able to kind of show you guys how I view prices, right? There was 2 aspects of the higher time frame objectives that I really wanted to go over there, which was the expansion model and the equilibrium model, right? The equilibrium model is essentially when prices trades back into the discount or the premium of the dealing range, and expansion model is whenever my higher time frame objectives lower high is different than my model's lower high. And as you guys can see here, there is the equilibrium model because prices wants to trade back into discount, and there is the expansion model. The 15-minute low is not the same low as the 30-minute low, but it suggests the same idea, which is lower prices. And now going back to the actual charts here, I do want to mention that with the way that this 4-hour candle here is closing and with the way that this 8-hour candle is closing, I don't necessarily have a bias, right? I don't really favor higher prices or lower prices here in this case, just because of the way that we're closing. And that's completely fine, right? I'm fine. I'm content with not knowing where prices wants to go. All that means is that I just have to be patient and really just wait until there will be a opportunity for me to enter. Yeah, as of right now, it looks like there's not really much for me to really do here. Just gonna sit on my hands. Nothing, no need for me to really force an idea here. Um, yeah. So one thing that I do want to mention, or not really mention, but really get into, is the pros and cons here with you guys. So I'm just gonna completely ignore the morning session here for today. Like I said, with the way that the 4-hour candle is closing, and with the way that this 8-hour candle is closing, I don't have a bias. If I don't have a bias, I'm not gonna force a trade. I'm just gonna stick to my rules, right? Even though we still have 30 minutes or 30 seconds to create this 4-hour candle and the 8-hour candle, I don't believe we're going to do anything significant within that time frame. So I'm just not going to force anything. And so let's go into the pros and cons here and just really do a recap of previous week and just some of the things that I can continue to do this week. And I'm sure you guys are tired of me going over the pros and cons. But it is something that I do want to just continue to, elaborate on and just really like hammer it into my brain that these are the things that you should stick to and these are the things that you should work on. So the first thing that I should stick to is taking consistent trades. And the way that I'm going to take consistent trades is requiring 3 components every single time I take a trade. And that is a higher time frame objective, a model, and an entry pattern. I already went over basically what those are to me, what those mean to me already. So I'm just going to keep it very simple. Is take consistent trades. Second, being able to align my model with the higher time frame objective. So you guys got a sneak peek of what that meant to me already whenever I did the trade recap. But essentially, my model is supposed to support the idea of my higher time frame objective. If my higher time frame objective is telling me that, hey, we should continue higher here, then my model should support bullish prices. If the higher time frame objective is telling me that, hey, we should take out this low, or if we should retrace back into discount, then my model should support bearish prices. Essentially, that's what the model and the higher time frame objective relationship should be. They should be supportive of each other, and they should be pretty much parallel, right? And third, from last week, was utilizing a time stop. I didn't really get into what a time stop was in the trade that I just took yesterday. But essentially, a time stop is knowing how much time you should allocate for a specific trade to perform. So if my model, like the model I took yesterday, was based off of the 15-minute time frame, I should only allow 15 minutes to pass before I move the stops to break even if prices doesn't complete the objective, right? The 15-minute candle here that I use as my model, this candle right here, right, suggests that we're most likely going to take out the 15-minute low. And one key aspect is that it was created within 15 minutes. So that means the next 15 minutes, we should complete that specific 15-minute objective. And that's essentially what a time stop loss is. And like I said, if prices goes over that specific amount of time, then I should move my stops to break even. And just from there, if I get stopped out at break even, fine. If we continue lower or expand towards my objective, that's fine as well. And so that basically sums up the pros for last week. And the cons are essentially, it doesn't really there's not much that it relates to trading wise, but it is something that I have been working on and a skill that I'm really trying to improve, when that is to fundamentally break down a company, right? To understand the core business model and really evaluate a company based off of its intrinsic value. And the way that I'm doing that is by using a discounted cash flow model. And it's simple to do because you're basically plugging in numbers that has already been given to you. The hard part is coming up with assumptions for for the future, right? For the forecasted free cash flows. That's a little bit difficult. Two things that I did learn about this model is that the cost of debt, the way that I get it, is I divide the interest expense divided by total debt, and that gives me the cost of debt. Cost of debt is used in the WACC, weighted average cost of capital. And the second thing here is just to really understand the concept of net working capital and change in net working capital. If it's a positive total of change in net working capital, right? If it's a positive number, that means there has been a cash inflow, and I get all of those numbers, the change in operating working capital, from the cash flow statements. And the cash flow statements directly tells you if there's been a cash inflow and outflow. And coming into this week, I do want to learn more about multiples and how to compare different multiples, different PE ratios, different PB ratios, all of those ratios with different companies. One thing that I think that you're supposed to do is that you're not really supposed to compare like Amazon to Nvidia or like Walmart to AMD, because they have completely different models, and they're in completely different industries. I think that the best approach whenever you are doing these like multiple comparisons is that you want to be comparing companies that are within the same industry. So like Nvidia and AMD, Walmart and perhaps Sears or Amazon. Well, Amazon is more of it's more of like an e-commerce side, right? Whereas Walmart is like you go actually in person. But I guess you can compare Walmart to like Costco. They're the same type of they're in the same industry. But yeah, so that is the pros and cons here for last week. And some of the things that I can continue to do here for this week is to take consistent trades. I already mentioned how I'm going to take consistent trades. Second, utilizing a time stop. Time stop is very important because not only should I have a price stop, but I should understand that if prices doesn't complete this objective within the amount of time, then I should really consider ending or closing the trade or moving my stop loss to break even. And the way that I'm able to get the amount of time that I should allow, that's by looking at my model. And third is aligning my model with the higher time frame objective and understanding how those two interact with one another, right? If the higher time frame objective is telling me that we should take out the low, then my model should be supporting bearish pressure, should be supporting bearish bias. And that's pretty much all that I had for you guys today. Going back to the actual charts here, it did turn out that we did end up taking out the 4-hour high, and I mean that's completely fine. I literally that's fine. I don't want to force an idea whenever it's kind of unclear to me where prices wants to go. And yeah, I think that's just gonna wrap it up for today's video. Today's live stream. One thing that I will leave you guys with here is pay attention to how we close here on the 6-hour candle, because that's going to be the next candle that closes. And depending on how we close here on the 6-hour candle will provide you with a new bias. So if we close bullish here on the 6-hour candle, then you should be favoring higher prices. If we close bearish, then you should be favoring lower prices. That's pretty much everything that I want to leave you guys with. Thank you guys so much for tuning into the stream, and until tomorrow.